Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting estimated net flows for the conventional fund business for the week ended Wednesday, September 30th, 2020. I will be talking about ETFs in each of the macro groups as we go down in detail, but these first top line numbers are really going to be just from the conventional fund business. We saw that it was about $21.4 billion that left the conventional fund business this week. It's the 8th consecutive week that they've actually seen net outflows. And this is despite learning kind of two things that were going on. First of all, the preliminary numbers for the unemployment rate came in via ADP, and they report the private sector employment string. Actually, the numbers came in very strong. I think people were very pleased with the numbers. And then what we've seen is the real estate group basically do really well. The new signings of real estate contracts were at an all-new time high in August. We just learned. Basically, we've seen new housing sales at new highs as well. So really, the real estate market has been on a tear as of late and has been doing very well. And we saw that the Nasdaq actually for this Wednesday time period posted a 5.03% return for the week. That is actually great after seeing, I think it's three consecutive weeks of negative returns. They broke that 3-week record, if you want to call it that, losing streak, I should say. And I actually put up some plus side numbers, and even the Dow actually was in the 3% range, so it did very well as well. So the broad-based indices in the U.S. did very well. However, people are very concerned with, first of all, continuation rising numbers in the coronavirus. Basically, they're concerned about the inaction by the government, Congress in particular, coming up with a deal that might be able to relieve, some of the stress put on by the COVID-19. We got the Democrats asking for, I think it's 2.3 to 2.4 trillion dollar deal with the Republican side of the aisle is basically trying to do something with one and some change trillion. So we need them to actually come to an agreement and work together. And I think that's the other thing is the impasse between and the divisive nature of the election process coming up. I think has just put a lot of people back on their heels, and they're kind of waiting to see what happens. Well, let's see how kind of these new changes that have happened, that have occurred, how they impacted the flows for this week. Basically, we take a look at the equity or the broad-based macro groups. The equity funds lost about $5 billion. Taxable bond funds actually handed back about $1.7 billion. And muni bond funds for the first week in 21 actually saw a $661 million outflow. And then the money market funds saw some big money leave their coffers. Again, not as big as we've been seeing over the previous weeks, about $14 billion. We'll be able to see some of those trends here as we go to each of the slides and the groups that we are going to take a look at. So that brings us to our macro group breakouts. And let's take a play-by-play look at what happened. First of all, we'll start with the equity arena and see what happened there. See that equity funds for the second week in 3 actually posted plus side returns. Remember, I told you, both the Dow and the Nasdaq actually, and the Dow was laggard, had returns that were in excess of 3%. We see here that the average equity fund actually returned about 3.20%. Again, second week in 3, they've seen plus side performance. But for the 23rd consecutive week, we've seen outflows, this time to the tune of about $5 billion. How that broke out is we basically saw domestic equity funds hand back about $3.3 billion, 16th consecutive week they've lost money, and then they had a very handsome 3.73% return on average. And again, it's about the second week in 3 that they actually have plus side performance as well. If we get to the non-domestic equity side, we see that about $1.7 billion left non-domestic equity fund coffers. 6 consecutive week they've seen net outflows, and they had a pretty good return, a little bit lower than the kind of domestic equity funds group, but the non-domestic equity funds returned about 2.05%. Also the second week in 3 that they've had plus side returns. How this broke out is we saw large cap funds hand back about $2.7 billion. Equity income funds handed back about $297 million. And if we look on the non-domestic side, we see international equity funds lost about $1.7 billion, while global equity funds handed back just about $80 million. Well, this is where we're seeing a little bit of the dichotomy, the change in pace, if you will, with what's going on in the market. We see that the authorized participants, or those folks that actually create and destroy ETF shares, You and I buy it on the exchange. These guys are actually creating the shares. Authorized participants actually put money to work back in the ETF arena. And if we take a quick look at their the slide here, we see that they actually added, for the fourth week in 5, about $5 billion in net new money into equity ETFs. Really offsetting. It's almost a push, right? I told you that the conventional fund business lost about $5 billion, handing back money, and the ETF side of the business actually took in about $5 billion. At the top of the arena, as far as attracting net new money, was Invesco QQQ ETF. Basically, it took in about $2.5 billion. The Spider S&P 500 SPY took in about $2.5 billion as well. Now, if we take a look at the Consumer Staples Select Sector Spider Fund, they were the big loser of the group, $657 million in outflows. And we see the Financial Services Sector Spider ETF also hand back about $460 million. So we are seeing a little bit of dichotomy and maybe a little bit more risk on behavior from the ETF side of the arena than we are seeing from the conventional fund business. Again, we've been seeing net redemptions for a very long period of time on the conventional side, and I think a lot of people are actually putting money to work in the fixed income arena, but we'll see this week that is not necessarily the case when we take a look at the fixed income funds. In fact, let's go ahead and take a look at that group and see what happened there. We see fixed income funds for the first week in 25 suffered their first net redemption. About $1.7 billion was lost from that group. It's the second week in 3, though, that they've had plus side returns, this time to the tune of 0.51%. And the big attractor of investors' money was corporate investment grade debt funds. They took in about $1.8 billion. And then we see that the government treasury and mortgage funds took in about $128 million. Now, remember I told you, risk on the equity side of the arena. But when we take a look at the, and this was for ETFs as well, when we take a look at the high yield side of kind of the thing, we've seen a lot of money going into high yield funds. This is not the truth here. I think this is where we're seeing that kind of risk-off play. High-yield funds handed back about $2.5 billion, and they were the main cause of them suffering, and them being the conventional fund business, suffering their first week of outflows in 25. Flexible portfolio funds also handed about $943 million back as well. So that is actually where we're having a little bit of a similarity. Remember I told you I gave you a contrast of equity funds, conventional fund versus the authorized participant. Well, this week we see that on the fixed income side there was some agreement of what should be invested in. So let's go ahead and take a quick look at what happened to the ETF side of the fixed income arena. This week they actually took in about $607 million. Fifth week in 6 they've seen positive, positive net flows, but at the top is this kind of risk off behavior. iShares 20 plus year Treasury bond ETF took in about $426 million. The iShares Core US Aggregate Bond ETF took in about $417 million. But at the bottom of the barrel, we see the iShares iBox High Yield Corporate Bond ETF actually handing back money. Now, again, this is in line with what we saw on the conventional side of the business as well. At the bottom, the second from the bottom, we see the iShares Short Treasury Bond ETF actually losing about $409 million. From that group as well. So really there was a story there, and again this fixed income indecisiveness, or some of the news that we've heard from the Fed, that they don't think they're going to let inflation run a little bit heavy, that they don't think there's going to be any big changes to the interest rates, at least for maybe even to 2022, certainly not for 2021, unless something drastic happens. So I think people were kind of willing to kind of stick in that area and still do the fixed income funds, but now we're seeing kind of a little bit of a meltdown in that area. Let's go ahead and take a look now at the muni bond fund side of the group and see what muni bond funds did. Basically, we saw that, again, for the first week in 21, that they had an outflow of about $661 million. The return was actually slightly negative if you go way out in the decimal places, but really what it does when we do the rounding, it kind of breaks out to just nothing. No return. So it's the second week that they did not lose money, so that's a good thing. Short municipal debt funds actually attracted the biggest draw. About $263 million came into that group, while general and insured muni debt funds handed back the largest one. Now, keep in mind, general insured has been the main attractor of investors' assets over the last several, 20 weeks or so. So $605 million in outflows there, and intermediate municipal debt funds lost about $234 million. Now, I don't ever put a slide up here because it's still a pretty small part part of the universe, although it's getting bigger. Municipal ETFs basically witnessed the first week of outflows in 4, handing back about $114 million. Well, that brings us to kind of the big outflows that we saw earlier. And again, a lot of people don't even pay attention to money market funds because they are considered short-term assets, not long-term that we see in equity, taxable fixed income, and tax-exempt fixed income funds. So a lot of people do ignore it, but we like to see what the trends are. And basically what we saw this week is that money market funds suffered again net redemptions, 10th consecutive week that they've seen outflows. Remember, I told you before, this wasn't big. It's big, but it's not as big as some of the other numbers. $50.5 billion and the like. Have been some big numbers, but $14 billion in outflows is still a hefty number. Taxable money market funds actually saw about $12.8 billion in net outflows. How that broke out is institutional money market funds handed back about $14.7 billion, while retail money market funds actually saw about $1.9 billion come into their group, and tax-exempt money market funds actually lost about $1.2 billion. And I think we'll see a trend here. We've seen a couple of big fund families actually claim that they're no longer going to support their municipal money market funds anymore. I think what it is, the interest rates are so low, keeping a crew and staff on. I think that because of the very, very low money markets, particularly the single state money market funds, we'll probably see some consolidation into, if you will, kind of the broad-based tax-exempt money market funds or general money market funds rather than the tax-exempt. So we might see a change there as well. Well, that really does it for me today. Basically, what we did see this morning, as I mentioned earlier, is we saw the non-farm payrolls come in at 661,000 for the month. That's how many new jobs actually were created versus what analysts expected, about 800,000. So it was a little bit on the disappointing side. The unemployment rate did drop to 7.9%, which is great. And again, I think people are just going to have over the next several weeks a lot of volatility as they try to see what's going to happen as far as COVID-19 cases go, as far as the general election goes coming up, and certainly if we have more debates. Usually debates don't turn markets sideways at all. We heard that President Trump and his wife, basically the First Lady, were diagnosed with having positive cases of coronavirus. So we'll have to see how that happens as well. I think as long as the president doesn't get sick, I think it's going to be a non-market event as well. But we'll certainly keep an eye on what's happening here in the near future. We'll keep an eye on, as we get going, more of the debates and how they turn out as well. So if I haven't done a deep enough dive for you today, you can go to our site at www.lipperusfundflows.com. Or you can join us next week when one of our analysts will talk to you about the flows trends of the week. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.